Welcome to another episode of the Bank Free Blueprint. Today I have Arthur Zwern. Welcome, Arthur.
Thanks for having me, Tom.
Absolutely. Arthur, you've got quite the interesting background. You have an MBA from Harvard. You also have an applied physics degree from Georgia Tech. You've been working here in Silicon Valley for quite some time, especially in the early years. And maybe, do you just want to share a little bit about your background and how you eventually got to the point of investing in real estate?
Happy to do that. Before my MBA, I worked for Hughes Aircraft Company for a couple of years, and part of my job was to look out 30 years in the future and figure out what the military would or could be doing and then start to prototype it. So that kind of kicked me into being an inventor. And so after business school, I came to Silicon Valley, which is where you go to do high tech and invent things and start companies and learn the ropes at a big company here, managing various departments, and then started a series of my own companies in consumer electronics, virtual reality. We ended up doing the most precise face recognition the government ever tested shortly after 9/11. So basically pushing a lot of computer vision technologies for the most part.
Wow, so very technical, but yet entrepreneurial. You've certainly been in the entrepreneurial side of it because of the businesses that you've worked in as well. So maybe is there any particular project that you really had a passion for when you were working on it?
Oh, I had a passion for every one, or else I wouldn't have done them. But I guess having that background as an inventor, but also being able to analyze things from first principles in physics and from very solid business methods, is really kind of the same approach I'm trying to take to real estate, which is everybody can find a house and fix it and flip it, but can I find deals that are extremely discounted compared to a unique strategy I can bring to add value? So I look at each parcel or box or whatever it is, and I say, it's really just an empty box that's waiting for the right business. And it's really about the business that goes in the box. So how can I create a unique business for that particular box or parcel of land that's going to maximize its value? It's best and highest use. And that's what I try to do.
Yeah. So very interesting. I know we met about a little over a year ago. You attended you started attending our Bay Area private money real estate investors meetup group. And we got to talking after a couple of the meetings and started talking about some real estate transactions that you had been working on. And now we're actually working with you on a project in Costa Rica. And could you just share some details of what your progression was when you started in real estate? Maybe whether you started totally passive or you started somewhat active, and what that progressed to, so listeners can get an idea of how to make that transition themselves possibly, and what to watch for in that transition period.
Yeah, there'll be a lot of steps to this, but when I was a kid, I learned that you grow up, you go to college, you get a good job, you buy a house. It was just, I didn't even question that. So my first house that I bought was in Silicon Valley in, I think, 87. And things were way overpriced then. And it was scary to buy a house. They cost about $200,000. And that was like way more than anywhere else in the country. And it just seemed crazy. The only way I could afford it, even with my Harvard MBA and my good job, was because the garage was detached and converted into a rental unit. And I had the renter built in on day one. So I immediately learned about cash flow and having tenants help pay your mortgage and how to get leverage, and got into my first house. And lo and behold, a couple years later, the house next door started looking more and more run down and nobody was mowing the lawn. And it turned out the little old lady who lived there had passed away. And one day I saw a bunch of people in black suits coming out of the house, and I went up to them and I said, "So what's with this house?" And they said, "The lady passed away. It's in probate. The heirs are arguing over it." I'm like, "Well, I'll tell you what, why don't you ask them if they'd rather argue over a pot of money earning 8% in the bank those days, or whether they'd rather argue over a house that's about to cause them a lot of trouble because I'm going to call the city about all the problems and the hazards and whatever." Right. And they got back to me the next day and they said, "Well, they'd rather argue about the money, and the least they'll take is $148,000, I think it was." And I'm like, "Oh, well, yeah, okay," right? Because I knew it was worth $200,000.
Right.
So that was my first rehab, right? My wife and I spent endless hours rehabbing this thing, making it beautiful. We rented it out on day one at a positive cash flow. And then years down the line, when we decided to move out of Silicon Valley, we sold it to our tenant. So it worked out really well.
Nice. And so at that point, it was possible to get good cash flow on properties.
Well, it wasn't normally unless you bought at a big discount. And so what that deal taught me, because every deal I try to look at and go, what's the learning experience here? That one taught me, buy low. You make your money when you buy. You don't make your money when you sell. When you sell, it's up to the market and whatever. When you buy, it's really up to you. So that's when you make your money. We had $50,000 of built-in equity coming in. So we knew it would be a good deal. And we knew we'd get a positive cash flow, right?
Yeah. One of the things we hear all the time is you make money when you buy. So yeah. So that buying at the right price. Just curious, that house that at that point was worth 150 or 200,000, depending on which one we're talking about. What? Just curious what the value of that might be today.
Oh God, today $700,000-800,000. But I can tell you that a few years later, when we 1031'd out of both of those houses, we sold them at like 450. Okay, so we more than doubled our money, not even counting leverage with the loans and whatever.
Right.
So those were the days, those were good days. But
and 1031 is just for anybody who's listening who might not know, it's a way to exchange into a property, another property, so that there's so you don't get hit with the taxes. Yeah, basically deferring. Yes. So okay, so you
jumped through a couple more steps. In 98. I got married and we bought our first house that was bigger that we planned to have kids in. We managed to keep my first house and turn it into a rental. And so what I learned there was whenever you can do that, it's good, because an owner-occupier gets much better mortgages than an investor. And so I took a house that had a good mortgage for that time as an owner-occupier and turned it into a rental and got that extra margin, which was nice, right? And it taught me about pyramiding real estate. I managed to take these two little houses that we had next door to each other and leverage them to go buy a much bigger house and a nicer house that I'm now about to move out of, finally 19 years later.
Nice. And I'm going to guess that possibly the next step after that, the next form of leverage might have been syndication, or?
No, not even close. What happened then was the dot-com crash, right? 2000 happened. And all of a sudden, my wife was an early employee at Cisco, and all of a sudden her $2 million of stock options went to zilch like that, right? And I looked around and I went, what are the other legs of our wealth stool, and what's going to happen to them? I'm scared now, right? And it was like real estate was the next big one, and it was all here. And I said, oh my God, one earthquake can knock it all down and we're toast, right? Or the market could crash here because the tech market crashed, so maybe the real estate market will crash because nobody can afford to live here anymore. I don't know, right? Mm-hmm. And I shouldn't have all my eggs in one basket. So at that point, we also had realized that we could fly to Utah, to Salt Lake, and get to Park City and ski quicker than we could drive to Tahoe. So we decided to invest in Park City because the Olympics were coming. Worked out great. We 1031 out of things here, bought a bunch of undervalued properties there, positive cash flows, and then doubled our money on those.
Wow. Nice transition.
Yeah, it worked out really
well. Wow. Okay. So then after that,
what I learned from that one mostly was, I learned a lot about running resort properties, which has its pros and cons, but also I learned about external market drivers. What I really realized there was the Olympics were coming. The appreciation from that hadn't happened yet. It ended up happening right after they came, when the whole world saw Park City and went, best snow in the world and blah, 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 let's go, right? So I look at external market forces, which is part of why I'm in Costa Rica now, because you've got a tourism market that dominates the economy. It's growing double digits every year, but we'll get to that later.
Yeah.
So, but then the appreciation happened in Park City and our houses all went up, right? And the way I look at rental houses as an income property is I don't want to speculate on them. I don't want to fix and flip. I don't want to hope it'll be worth more next year than it is this year. I want to see really good cash flow, right? And if I know I've got good cash flow, I don't necessarily need to sell. I'm happy to hold it, right? I'll sell when the price is so high that if someone bought it at that price, they can't possibly get a good cash flow. Yeah. And that's when I know pricing's stupid high and I want to sell. And when it's stupid low, it's when I want to buy. So we sold out of Park City when it started to get stupid high. It turned out to be 2006. I made the biggest mistake of my career because I believed all the people who said when houses go down, apartments go up. So we 1031'd out of Park City inflated, nice, gorgeous houses into apartment communities in Texas, hoping for great big cash flow. I was going to retire. Well, that was 2006. And by 2008, what happened? Well, the bottom fell out. That's when I learned that debt and the leverage you get out of it works two ways, because all of a sudden I went from a double millionaire on paper to a double negative millionaire on paper. And it was not fun, right? And that was that. We could do a whole session on how you work out of a thing like that without leaving a nasty trail, right? And work it out with every creditor and push this out and change this. And what are we going to do about this property, right? There's ways to do it and ways to not do it. But
definitely,
I can tell you, just as a short version, that everybody told me it's absolutely impossible to do a loan mod on a CMBS commercial loan on a big apartment community. It's not impossible. You just have to be really good, right? They also said it's impossible to keep a property like that in a short sale and do it yourself, as opposed to handing it to a receiver or whatever, which causes you endless problems for the rest of your life. It's not impossible. You just have to have the right plan for the special servicer that convinces him you've made his life easier rather than harder.
Sure.
Right.
Okay.
So it's really one of the things I've learned through hardship is real estate is not about land or buildings. It's about people.
Yeah.
It's all people, like every other business, right?
So true.
It's about people.
So true.
And so your reputation is really important. Your ability to tell the truth and be transparent and go, hey, I've got a problem. Let's work together on it.
Absolutely.
Really critical, really critical, because a lot of people want to hide things, like, especially you look at what goes on Wall Street, right?
Right.
Hide things and use funny accounting and make it look like we're making money when we're not, and this and that and the other. Real estate, like, let's just look at cash flow.
Yeah.
You can't fake cash flow, right? If I see money going in the bank or money coming out, I know exactly what's going on, right? I don't need to look at a bunch of funny numbers.
Yeah. Yeah. And the other thing is to act quickly, act succinctly, get in there, get the job done. I mean, I remember when I was going through some of the tough times, it was hard to muster up the energy all the time to be there, to be right on top of things, to make them happen. But that's the difference between making it through it and not making it through it.
You have to be absolutely dedicated to making it through it, right? And not be a quitter, right?
And tenacity.
I'm not going to file bankruptcy or whatever. I'm going to make it all back and more, right? Because I'm a pretty smart guy, and external forces whacked me, and hey, what can I learn from it? Well, here's a few things I learned. One, diversify, right? I didn't diversify. I shifted most of my assets from California to Utah to Texas. Well, now they're in two different states and another country, right? Not all in one basket, right? No one problem can take me out, right? But I didn't realize that then the way I should have, right? And I learned about leverage, right? The big asset I have now in Costa Rica, it's a multi-million-dollar rental. There's no mortgage on it, right? Yeah. So no one can ever come take it, right? If my revenues crashed by 50% tomorrow, it would hurt. Our income would be lower. But I guarantee you, on any property you buy in the US with leverage with a mortgage, if your gross income falls by 50% tomorrow, you can't pay the lender next month. Yeah. You're toast, right? I don't ever want to be in that position again. I know what it feels like, and it's really, really ugly and scary. And you can make a lot of money in real estate without taking those risks.
Right.
Without those risks.
Right. Okay. And so at what point then did the syndication come into play?
Well, the first two projects I did in Texas were multi-million-dollar apartment communities in 2006.
And like how many units?
Both. One was 100, one was 122. And I could afford to do one by myself. And I wanted to do both, because I thought diversifying between Fort Worth and Dallas would help, and this kind of property versus that kind and whatever. So I did both and brought in other partners for, roughly half of the total, right?
Okay.
So in the end, one of them became a big, a write-off for us. The other one, which had the same lender, ended up making seven figures and making up for the loss on the first one. So, it's sort of, it wasn't a total wipeout, but it was a big learning experience.
Right.
However, what it also gave me was I knew the Texas market. By the time the market was at bottom in 2011, 2012, I knew the market. I did another syndication where we bought a rundown property out of receivership at $8,000 a door. And we sold it last year for 40 something, right? It was a record, right? So at that time I knew when everybody was saying, don't buy any real estate, it's a disaster, the market's crashed, blah, blah, blah. At that point, that's when I look at the market, any market, could be sugar, could be houses, whatever. That's when I look at the market and I go, my risk is lowest then because it's already gone down as much as it can ever go down. I know that it's not going to go below zero, okay? And I know that if I buy something at $8,000 a door, I can fix it up beautiful for another 8 or 10. And at that point, the cash flow I can get on it makes it worth 25 or 30. I don't care what the market says at that point. The cash flow tells me it's worth 25 or 30. Eventually the market will figure it out, right? Because markets are cyclical. And you know what they say in the short-term markets are a voting machine, right? It's about what people think and feel. It's their emotion. In the long term, they're a weighing machine. Like how much gold is really in this closet, right? So you got to look at that and go, I want to be where the market isn't, right? When everybody's saying sell that, I want to wait till the last sellers are exhausting themselves. And at that point, I'm in there trying to get it, you know, blood in the streets kind of thing.
Yeah.
Because that's the lowest risk time to buy.
Right. Who was it? Was that Warren Buffett, Blood in the Streets, or was it Rothschilds? Or
he's a great person to read, by the way. I mean, just read his annual letters to his stockholders, and you will learn so much. Very valuable.
Warren Buffett.
Warren Buffett. Yeah. Berkshire Hathaway.
Yeah. So I think the saying is, buy when there's blood in the streets.
Yeah. And when I want to sell is when everyone thinks there's blood in the streets, right? So, for example, I've sold out of the big apartment communities in Texas right now. Why? Well, you can still make money on them, but we sold one last year. It was a C-class boiler chiller, all bills paid, 1960s product, okay? The buyer bought it at less than a 6 cap, okay? Cap rate being, if he didn't leverage it all, then at the end of the day, he'd get 6% of his investment back each year in operating return, right? But I know that that's before CapEx. And I know CapEx in an old property like that is way more than anybody projects, especially any broker. So I knew that his real cap rate was going to be more like 4. And I'm like,
CapEx meaning the work that needs to be
yield, right? If he didn't leverage it all, he was going to get like a 4% yield. I'm like, I don't think I'd even do that if it was an empty pad that a Walmart was renting from me, a really good credit, right? Much less all the hassle of low-end tenants. So I know at that point that the market's overpriced. There's too many people chasing deals. Every newbie is going to Texas trying to buy an apartment. I was literally telling people last year, there's more apartment buyers in DFW than apartments. So what do you think that does to price? When there's too many people running around with too much money, the price gets inflated to the point where the last person who buys at the highest price, it's called winner's curse in the auction theory. That's you're the fool, right? You paid more than anybody else is willing to pay. That's what the market looked like. I'm like, that's a time to sell. Now, where can I go that's crashed that I can get really low values? And so in 2014, when I started selling apartments, realizing that the Fed has pumped real estate up way too much and the yields are too low and the cap rates are too low and it all has to revert eventually, that's when I said, I got to look offshore. Where can I go where there's a real market that doesn't have a Federal Reserve handing every financial entity in the country free money and saying divvy it out somehow and try to multiply it, right? Because what happens is all that money going on in the system gets everybody buying assets, right? So why do you think oil prices crashed? Because too many people drilled oil wells because it was so cheap to get the money to do it. And why do you think we're worrying about deflation now in so many commodities? Sugar crash, coffee crash, gold crash, everything crashed, right? Because anybody could get a loan to go make more of something, but to drill a mine, build a factory, whatever. Once the financial system got through with all of the commercial credits, they went to the consumers, right? And started trying to grow there and make more money there. And they couldn't get stupid about it with mortgages because of all the rules that got put in place after the last crash. So when all the good consumer credits borrowed all the money they wanted, and they had to go to the bad consumer credits, what do? Well, now we've got trillion-dollar subprime car loan markets that are blowing up, trillion-dollar credit card markets that are at risk, And we've got trillion-dollar student loan markets that are blowing up. And guess what? Now people are getting out of their student loans because the lenders can't find the paperwork. Does this sound familiar, people? Okay, so it's going to blow up exactly like it did. Credit markets are always cyclical, right? And people are always trying to solve the last problem instead of the next problem. So I don't think that the next credit market blow up will be real estate, but it might very well be the oil industry and student loans and credit cards and subprime auto all hitting at once over the next year. I don't know.
Okay, so you go from working here in California, you go to Texas, you start working outside of your local area. Lessons learned, advice. You just mentioned the projects that we've been talking about in Costa Rica.
Yeah, I'll get to that now because one thing I've learned is that when I went from California to Utah, or then went from Utah to Texas, or then went from Texas to Baton Rouge, or then expanded from the US to Costa Rica, every one of those changes came with new things I have to learn and fear of the unknown and different ways of doing things, right, that I could get smacked by if I wasn't careful and didn't surround myself with smart locals, right? Every one of those. And when I look back now, I go, the change I had to sort of deal with in going from the US to Costa Rica was less intense and challenging for me than from going from California to Texas, right? If I could tell you stories of the way judges work in Texas, that would scare the heck out of you. I still invest there, though, because you learn how to work with the system, right? Same thing in Costa Rica. The biggest challenge for me there is I don't speak Spanish. Okay, so I have a lot of bilingual people working with me, right? That makes my life a lot easier there, right? I know they're good and I can trust them. But so why Costa Rica? Well, most tourists shop jewelry store windows when they're on vacation, and I shop real estate office windows. And so my wife dragged me to Costa Rica in 2014 because she loved it. And I'm looking in a real estate office window and I'm falling in love with the place because everybody's so friendly and it's just amazing and beautiful. And I see this little 6-room hotel for sale for $600,000 that says it makes $60,000 a year. I open the door of the real estate office and I look in at the guy and I say, so that little hotel yam looks like a 10 cap. I want to know more about it. He goes, you know what a cap rate is? And I go, of course I know what a cap rate is. I'm a real estate investor. And then I looked at him, I go, you know what a cap rate is? Right? Some little podunk broker in a little office in Costa Rica. Well, sure enough, he did. And we started talking and I realized he really knows his stuff, which most realtors, you got to question that, right? Anyway, long story short, some of the best deals I've ever done were because a deal fell through for some other buyer and I was in the right place at the right time. What happened was I couldn't buy that hotel because an Italian bought it, but I was sitting in his office 3 months later on my next trip shopping and he had a deal canceled and he hangs up the phone and he goes, you should buy this. And I said, what is it? He goes, it's a big mansion on the beach. And I go, I'm not some billionaire trying to buy a beach toy. I want to buy a hotel and make a good cap rate. He goes, well, think of this as a hotel for one guest party at a time. I go, oh, that's nice and simple, you know, Airbnb kind of thing, whatever. I go, you think I can make a 10 cap? He goes, maybe. I'm like, let's go take a look. So we go look at this house and I walk in and I'm like, this house is like 17-mile drive quality, Beverly Hills, where I grew up. I mean, it's like mansion, this, like foo-foo that. Wow. I mean, I've never even imagined renting a place like this. And you're telling me I can buy this and come and I have to visit it to manage it. And I can actually make money on this at the same kind of, you know, basic rate of return that I can make in Texas that I think is really risky now. You know, where do I start the due diligence, right? And so we started on the process and ended up acquiring this beachfront estate that's just off the hook beautiful and rents for $10,000 to $30,000 a week, right?
So first thought that might come to some listeners' mind might be, how do we know the risk factors in Costa Rica? What are some things, and you and I have talked about this, some of the things that Costa Rica has that is really can make it quite stable?
You got to look at every different country, just like you look at every different state, right? And so just to take it back to state for a minute, different states have different property tax regimes. So let me give you a Texas example. Every year they reassess your property, right? If you have a big apartment, they might reassess it from a $3 million value to a $6 million value, and your taxes just went up $40,000 a year. which when you multiply that by a cap rate means your property value just went down by like whatever, $800,000, some big number, right? And then you have to go protest and fight it. And sometimes that comes to lawsuits where you're suing the county, right? And the county knows exactly how to negotiate and cave to the point where you're still paying about $5,000 a year more than you really should. But as an out-of-state apartment owner, you go, it's not worth the hassle at this point. I'll just settle, right? They play those games with you. And so I've actually had to sue them a couple times. But then after you sue them, they go, oh, I don't want to mess with that guy next year. I'll just, leave it the same, right? So you'll learn things in each new place. So you go to Costa Rica and I go, well, first of all, it's rated very safe compared to other countries when experts do studies, right? It's got a very Western style financial system. There's no currency controls. There's low taxes. There's no capital gains taxes. Foreigners can invest there. You can own property. The court system works similar to here. A lender can foreclose similar to a non-judicial state here. So it takes like 90 days. So it's sort of like they respect property rights there. There's low crime. People don't have their hands out every minute. And the country was sort of set up in a magical way. It's been a democracy since 48. So it's the longest democracy in Central America. No army by their constitution. Right? The constitution, the government is all about the people like ours is supposed to be. Mm-hmm. They have a higher literacy rate than the US. They have a higher rated public healthcare system than the US, number one in Latin America. They have fresh water everywhere. You can drink the tap water there, and good food, healthy food everywhere, and good weather. So the natives, the locals who call themselves Ticos, are happy, even when they're poor. They're happy. Why? They have good schools. They have good food. They don't have to worry about getting called off to war. It's nice and peaceful. It's beautiful. What's not to like? They don't know that they're missing glass in their windows and that they should have that. That's not their thing. That nobody taught them that, right? So they're all happy, right? It's a very happy country, and it gets rated the happiest country on earth. So I go there and I go, it feels good to be there. It feels good in my person to be there with the people. I don't feel unsafe like I do in Mexico, or even parts of San Jose. And it feels safe as an investor because I trust the government and I know that they follow their constitution, and I trust the business process there and how it works, and I've learned the differences between there and Texas and Louisiana and Utah and California.
Right. Okay. Another thing is that the cost of labor, the cost of getting things done there, alongside of being able to get returns or get income from certain properties that are much higher than representative of the cost.
There's a few aspects to that you'll find in Costa Rica and maybe other countries, I don't know. But first thing in Costa Rica, there's no multiple listing service. There's no Zillow, there's no Trulia, there's none of that. So there's not like one simple, easy marketplace for buyers and sellers to meet. And there's no simple place to get price discovery. You can't get comps unless your broker happens to know of this deal or that deal, right? What that does is it's the opposite of an efficient market like you're taught in business school. It's a market where if you have some inside knowledge, you have a big advantage. Well, so I develop inside knowledge and inside contacts. I know when I can get a property from a desperate seller for a fraction of what it's worth. And the reason he's a desperate seller is he's been trying to sell it for 2 years, but there's no good place to sell it. So nobody really knows he's trying to sell it except whoever happened to see the sign in his front yard, right? So, and then there's also a big lack of lending infrastructure there. There's, a mortgage, if you can get it, which you probably can't, is like 8% to 10% rate, 50% loan to value. So it's mostly cash deals, seller financing, things like that, right? So I go, it's almost like every property is distressed, right? It reminds me of the dark days in the US when it didn't matter that there was an MLS because there was way more properties than anybody wanted to buy, right? So it was all about who's the most desperate person to sell me their property today. So that's what you can play down there. And then what you get is when you start to operate it or you want to develop something, you find out that you're in a world where you're paying Tico costs, Costa Rican labor rates, like $2 an hour, including all their benefits, which are better benefit plans than the U.S. workers have, by the way, in terms of workers' comp and vacation plans and retirement, whatever. But the costs are so low, but your rates, whether it's a nightly rate for a rental or you're selling a property to a foreigner, those are all gringo prices, right? So you're getting gringo revenue rates and Tico cost structures. And so unless you have to import something like a high-end appliance, anything that can be created in Costa Rica, whether it's stonework or welding or beautiful custom wood cabinets or whatever, it's cheap, cheap, cheap compared to here. So we can build beautiful luxury for $100 a foot, like handcrafted things and so on.
And how do we work with the fact that it's an inefficient market, and we have the people that, like you said, there's a lot more properties than buyers for. So I know that part of it is about cash flow, part of it is about marketing, part of it is knowing the right people. But what's your take on, what's your answer?
My take on that, which is true in Texas also, is I like to buy like a local and sell like a gringo, right? So what that means in Costa Rica is I'm trying to buy properties where somebody's foreclosed on it and doesn't want it, or somebody needs to get out and they don't have a good way to get out. It's not really their business to sell properties, right? Okay, now I go develop it and I want to go sell. Well, I'm not just going to put a sign in my yard and a little flyer on the real estate office. I'm going to go talk to International Living Magazine, who has 100,000 subscribers, and say, let's do a deal where you're helping to promote my property and you're getting the real estate commission cut or this or that, right? Or I go to Kathy Fetke or Real Wealth Network, who's working with developers in Belize and Costa Rica and all over, and I say, you go market my property for me. Let's do the numbers, and here's what you get, and here's what the investor gets, and here's what we get. And it's a win-win-win-win-win. So, you've got the market, right?
Which is also, it ties in again with that inefficient market. Exactly. The people who are efficient with what they're doing creates the efficiencies within those single properties. Yes, exactly.
Market for my properties by using first world marketing tactics, right? Instead of developing world marketing tactics.
Yes, and
that's what most people use down there.
Right, and the rates for places, and I know the project that we've been working on together, vetting. It's a project in Costa Rica, and the amount of income, the income that can be generated from properties is amazing. I mean, it's definitely first world rates.
Well, so the first property I did down there, which was really to get my feet wet, and it was about not taking risk. It wasn't about going down to Costa Rica and taking a big risk. It was about avoiding risk, right? So it's a trophy estate on the beach in a country where everybody loves the beach and tourism's growing like crazy. And maybe 1% of the beachfront land is even titled. So trophy land asset with a big trophy physical asset on it. And we bought it at like 2/3 of its market value. So I knew I was getting it at a good price. Well, we've turned it into the highest grossing rental in the area. So we're getting close to $300,000 a year now, gross rental income on it. And got this, passing 150 in net. I hope to get to 200 in net pretty soon. But between the income and the appreciation over the course of a 5-year hold, I'm hoping for each to be 10% a year, basically. And so it ends up looking like really good numbers at the end of 5 years. But the key to that is people say, well, God, your minimum yield is 7%. That's low compared to other syndications. And I go, yeah, but that other syndication is an apartment community in Texas with a 70% loan on it. And this has no loan on it. So you got to compare risks. You can't just compare returns in this world. You have to look at risk. And you have to adjust that return by the risk. And most people completely ignore risk. Why? Because we don't have good math for it. Mm-hmm. It's totally subjective. Yeah. Basically, we confuse comfort and feeling safe with true risk. Oh, and that's why a lot of people don't go out of state. So we should talk about that for a minute, right? The first thing I tell newbie real estate investors here in Silicon Valley, I go, so you own your own home, right? That's step one in real estate. They go, yeah. You got some equity in it? Yeah. I go, you got a good job here? Yeah. Oh, and you bought your first rental property here? And they go, yeah. I go, so right now you're 30 seconds away from your job, your home, and your wealth getting wiped out in an earthquake. Did you realize that? Have you ever thought that maybe that's a risk you should worry about? They go, no, I never thought of that. I say, well, so you buy fire insurance, right? And they go, yeah. What's the risk your house is going to burn down? Probably about the risk of an earthquake. You buy car insurance. What's the risk you're going to crash? maybe the risk of, I don't know what kind of driver you are, but the point there is that we insure ourselves against these tail risks, but we don't imagine it's going to happen every time we open our house or get in our car or whatever. Well, earthquakes is a big tail risk. And have you priced earthquake insurance lately? And the deductible? So even if you have it, you still got to come up with 6 figures on each property. And by the way, your office fell down or is closed because the freeway fell down or whatever. So your income's not there right now. So I look at that and I go, the first thing you should do, sir or ma'am, is take that overappreciated local rental property, sell it, and go buy 3 or 5 properties in Texas or somewhere that's going to get a good cash flow and yield. But it gets you 2 forms of diversification. One, gets you out of the same disaster zone. You now face different natural risks. There's nowhere that has no natural risk, but you want different ones because they happen. And they're the bad ones, right? And wherever they happen a lot, that's where you can't really insure for them. Try getting flood insurance in Louisiana, right? Good luck, right? Second, you want to diversify from state tax regimes. We happen to live in California in a very oppressive state tax regime, right? If I ever want to leave the US and live somewhere else in my final years, I have to move to a 0 state tax state in the US and establish residence there just to wipe California claims off of me. Otherwise, they'll want to tax me the rest of my life, just like Uncle Sam. And that's just not okay with me. At least in California's case, there's a way to do something about it, right? But I diversify from a particular state regime because they're getting needier and needier too and having more and more problems, right? And so, yeah, diversify to another state. And then right now I'm looking at the situation nationally and I'm saying, so we had this big crash in 2008. The Fed took as much money as they could print and handed it to all the financial institutions and said, give it out. It's inflated all the assets. The only reason people aren't questioning our government's ability to pay is because their interest rates are so low. But if you double their interest rates, our government's financials and books look really scary too. And I think no civilization that's led the world in history has ever survived printing funny money, right? The Romans didn't even survive it, right? And so what makes us think we will? Well, it's because context, right? We've lived our whole lives in this country with this one context, and we think that's the only way it is. And every time I start to think like that, I say, I need to get on a plane and go spend a couple weeks in a new country that's as different as I can imagine from other countries I've been to, because that'll teach you. Right?
It's a reality check.
It's a reality check where you go, everything around us here is a construct, and it doesn't necessarily have to be like this. It's like this because it happened to evolve that way through a combination of billions of individual investor decisions and political wranglings and whatever, right? It just happened, right? It's not the only way. And it will change. I guarantee it will change dramatically in the next 10 years.
Yeah. So I just want to kind of summarize here. In just a bit, I'll ask you about the project, the turtle-based project.
Yeah.
I'll let you explain it, and then if you have resources to share. In the meantime, if you're listening to the podcast, watching the video, if you think of any topics that you would like us to cover on this Bank-Free Blueprint podcast, would love to hear from you. Make sure you just send us an email, send it to tom@braegelmann.com. You can sign up for the podcast at iTunes or Stitcher or SoundCloud, any of those. Really the purpose of the show is to help everyone invest safer, better, be more profitable. So anything that we can do to match the target that you're aiming for to help you get to that point, would love to hear from you on that. So, but let's just, if you could just maybe take just a minute or two, couple of minutes to describe the project in Costa Rica, and then we'll go to maybe some resources that you've found helpful.
Sure. So now that I've been in Costa Rica for a couple of years and I've got good connections there, I'm getting deals that come across and looking at them just like I would have done that here in the past. And one of them is 7 acres right on the main nesting beach of the leatherback turtle, which is the oldest and largest marine reptile and extremely endangered, very threatened, at risk of extinction. And I looked at this land that's been in legal wranglings for years and it's finally getting freed up to go develop, and it's set for developing 18 houses or I'm sorry, 14 houses. And I thought, so what could I do there that's better for the turtles than just plopping houses down? And the answer became create an intentional, like a resort, a condotel, where everything about it is themed around saving the turtles, not just viewing the turtles, or what I think of as, they talk about ecotourism. I think of it as eco-viewism. It's not about eco-viewism. It's about eco-activism. We're going to get everybody involved in saving at-risk nests, helping baby turtles get to sea, cleaning the beach, tweeting about Chinese fishing practices that are decimating the oceans. There's a whole bunch of things that we can do at that location, which is an extremely beautiful, pristine beach, right? And so we're designing the villas that'll be rentals. They'll almost look like turtles from space, and even the walkways will be, stepping stones that are turtles. It's not going to be kitschy at all. It's going to be very, very classy and upscale. But it's really aimed at millennials who want vacations that have meaning, and they want something new and different. And I look at this and I go, well, you could go to Galapagos or a safari in Africa and have a similarly rare and amazing experience with nature. And we're going to do it for a fraction of the cost because it's right in Costa Rica, an hour from an international airport, right? Yeah. So in looking at this land, I looked at what's the highest and best use. So we're going to build these 14 villas, but they're going to be full of lockouts so that the rooms can get rented individually. And the villas will have a good cash flow, and we'll market the villas to individual investors. But here's the key thing about this land, okay? $650,000 for 7 acres on the beach. Okay, so
that's already approved.
Yeah, it's almost all the entitlements are done. It's just about there. But find me a tear down lot in San Jose for $650,000. I don't think you can, right? And this is 7 acres on the beach, surrounded by national park. So it sort of has a monopoly location in a national park. It'll be the only resort of its kind. They're probably the only one they'll ever allow. And it'll be unique in the world, right? And I'm looking at that saying, can we help create a new model for eco-activism where, in this case, it's codenamed Turtles First. Can we create eco-activism where we put nature first, wherever the resort is, right? It might be eagles first or elephants first or whatever, but we need to start looking at these animals and saying, what do they need? Can we provide what they need in a way that's a big win for them, a big win for the tourist who wants to come, and a big win for the developer? Because I think we're going to get unfairly high margins and unfairly high occupancy and all those other good things because of the uniqueness of this resort. Yeah. The turtles aren't a negative to us, they're a positive. Yeah.
And it's going to be a very high-end, classy resort. And I think some of the designs that you shared with us, and just, it's going to just be amazing. And if once we get to that point, I'm sure we'll have the ability to put some of those photographs on the website, and we talked about you doing a presentation at one of our next real estate investment club groups here in San Jose. So that may well be part of that. So really, yes,
looking at us,
right, exactly. Yeah. So that's really exciting, and we're talking a little bit about the possibility of even doing a documentary of the process, start to finish, and bringing in all the facts about turtles and about what you said about fishing practices and all those types of things. I think it really could make an impact. Okay, so let's go to the last thing here, and that is, I always ask if there's any particular resource or resources that you can think of that you think would be really valuable to the listeners, and that have been valuable for you. What comes to mind for you?
Well, let me start by just giving my one most important piece of advice, I would say, with me being the resource, which is that it's absolutely critical in your financial life to diversify. And I'm not just talking real estate. I'm talking, you wouldn't only own stocks. You shouldn't only own the stock from the company you work in. Diversify, right? Because risks are real. They can be catastrophic, and you never know what the next one will be and where it's going to hit. You just don't. And no matter how smart you are, how many books you read, or how much economic sense you have, you just don't know, right? Because it happens. And I saw something from a Stanford professor last night that suggests a whole lot of things are going to change around here, and with automatic on-call cars and things like that. It'll be very different in 10 years. So what that means really is you diversify to reduce true risk and to try to achieve high returns. You might be selling high in one country while buying low in another, or one commodity or stock indice or whatever. In order to do that, you have to give up control. End of story, right? You must give up control. You can't personally control everything you invest in every different kind of market, in every different country and whatever. You're giving up control to other people. Try to pick smart people, right? But you're gonna reach a point where you feel unsafe, right? It's not comfortable to give up control. And we think we should have control in real estate, right? It's not comfortable to give up that control, but you do it every time you buy a stock, right? You just do. You have to, right? So get a little comfortable with that and realize that your discomfort at giving up control is actually fear, not risk. The risks are real things out there in the market, or the risks are your lack of knowledge about how to do something right? And that expert in that other town doing another project probably knows a lot more about you about how to do it. So you're actually taking less risk by giving them a little bit of your money and saying, go do your thing and be the expert and take care of my money, right? As long as they're honest and transparent and have a good plan, all the regular due diligence you do, but you're going to have to give up control, and don't confuse that fear of giving up control with risk. It's two different things. And most of us don't know how to separate them.
Yeah, very
so
good.
In terms of a resource, I don't have particular resources I look at all the time, except that I'm a devout subscriber to Stansberry Research, which is a financial house that does a whole lot of newsletters. I'm a lifetime subscriber. I read all their newsletters. Some of them are bearish, some of them are bullish. Sometimes they agree, sometimes they don't agree, but they give you a real good sense of what's going on out there and how history replays. And it's happened this way 12 times before, so it's probably going to happen this way again, or here's why this time's different. I really love their stuff, right? And they have some newsletters that are real cheap, $99 a year, and they have some free daily things that I would highly recommend. Stansberry Research, you could Google it. But then in terms of the most one important sort of financial number I'd be keeping my eyes on now at this point in our market, which I think is call it a very mature bull market in many ways, with a lot of cracks showing. I'd be looking at the spread between high yield or junk bonds, as they're called, and treasury bills. Why? Because the bond market's usually much smarter than the stock market. That's been now proven in studies. But the bond market prices risk, right? That's all they do. They price risk. And so if the spread between T-bills, which are assumed to be zero risk, is small from there to junk bonds, which are assumed to be high risk, they might default, whatever. If that spread's small, values are very compressed. Values are inflated. Yields are very compressed. Everybody wants to take risks. They're all reaching for yield. Okay, when everybody's reaching for yield with all this free money, that's when you get a bubble. That's when you get a mania, which it seems like we might be in the last stages of a melt up right now in the market. Well, melt ups usually are followed by meltdowns, because at some point, some external force happens that pricks the bubble. And I got that from Doug Duncan, the chief economist at Fannie, right? In a private discussion about what causes crashes. And it's like you get stressed, more and more stress in the system, and then some external event happens. And all of a sudden, boom, right? You're in deep trouble, right? It's going to happen again somehow. So keep your eye on that yield spread, because when the yield spread starts to widen a lot, that tells me a few things. One, the bond market all of a sudden senses risk. There's risk in the air. They're scared. The stock market might not have realized that yet, but when they do, it'll probably go down. Second, when junk bond yields go up, that means interest rates are going up for all the rest of us who are essentially junk bond and, borrowers, right? We're not Intel or Microsoft, that gets the 2% credit, right? We're junk bond borrowers in a sense, unless we're buying a subsidized mortgage on a house that's agency guaranteed, whatever, which is not priced by the market. It's priced by the government and Fannie and so on, right? So keep your eyes on that spread. When it starts to go, look out below, I'm really scared. Time to sell your stocks, go short, whatever, right?
Yeah. Okay. That's great advice. Just for anybody who might be listening to this while you're driving, don't worry about writing down the name of one more time the name.
Stansberry Research.
Yep. So Stansberry Research. We'll and we'll put the link to that in the show notes so that you can grab that when you're done driving and parked. So, any last words that you'd like to share with listeners? Anything that comes to mind?
Well, I guess, we didn't really get to the reasons to diversify internationally, but there's a number of reasons that go beyond finding a good deal with a good cash flow. One is you get asset protection and privacy. It's very hard for the U.S. government to come take something of yours that's in another country that's real estate. A financial account, sure, they just send a memo to that bank and they pull your account, right? But real estate, they have to go through a bunch of due process that they don't know how to do. Yeah. Similar for creditors. A creditor, they probably won't even see your real estate in another country, but then how are they going to come after it? The most they could ever do is attach income that you repatriate. But there's a bunch of other benefits, right? There's the fact that if you want to open a foreign bank account, it's much easier if you have foreign real estate. Usually they'll tell you to take a walk unless you can show that you actually have a business interest in that country and you have a reason to open a bank account. If you ever want a second passport or residency, much easier buying real estate, right? So there's the privacy. There's also currency diversification that you get, right? There's a long list of reasons.
Yeah.
There's tax benefits, right? If you structure things certain ways, you could leave profits in another country until you repatriate them, just like Apple and Google are, right? Yeah. It's all over the news, right? There's nothing that says big corporations have different rules than small corporations, right? You can put things in a trust in some countries where nobody could ever figure out where the money is, right? Yeah. I'm not suggesting doing anything here that's illegal. I look at the playing field the IRS sets up and say, how do I play my best game there, right?
Right. Oh, that's great advice, and it leaves a lot of things where we can potentially talk about again on future episodes. So thank you very much for sharing everything that you've shared with us.
I think it's helpful for the audience.
Absolutely, yeah. And if you like what you're hearing, if you enjoyed it, make sure you take the time to share it with a friend. Would love to get reviews on iTunes. If you have a chance to do that, that helps out a lot, because that triggers, it ranks us higher so that more people can hear us. So again, the whole reason for this podcast is to help people grow their business, do business safer, learn from lessons that we all have gone through. And so really to help people out. So if you can think of any other topics that you'd like us to cover, make sure you let us know that. Just email us, tom@tombraegelmann.com, and check us out. Let's continue this and make this real estate investing business more interesting, more profitable, and safer. So, Arthur, I want to thank you again for taking the time. It's been a pleasure and a great session here. A ton of information, and definitely looking forward to another one. So thank you, Arthur.
Thank you, Tom. What Tom says about coming up with topics is true, because I suggested the topic of diversifying first out of state and then offshore about 3 or 4 days ago.
Absolutely. Thank you. Thank you, Arthur.